bags. Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough illustration on how to properly record adjusted entries. So if you're unfamiliar with what adjusted entries are, I dropped a link that'll get you up to speed in no time. So with that being said, let's get it. It says to consider the following situations. Let's click on these situations. We have 4 transactions. All right. And it says, assume the company records adjusted entries monthly. Journalize the adjusted entries needed as of January 31st. Blah, blah, blah. Yada, yada, yada. So, basically, we're going to adjust the adjusted entries at the end of this particular period. And so what we need to understand is that there are 5 basic adjusted entries that I covered in the previous video in detail. That consist of prepaid expenses, depreciation, accrued expense, accrued revenue, and unearned revenue. So let's get to it. Business receives $3,000 on January 1st for a 10-month service contract for the period January through October 31st. Okay, it tells us when the cash was received on January 1st, assume that the liability account was credited, assume services are performed evenly throughout each month, yada, yada, yada. Okay, so keywords in here: business received $3,200, service contract for the period January through October 31st. So initially on January, what happened, gang? This company received cash in advance for services to be provided for the next 10 months. Now, this is a proper example of unearned revenue. Why? Because unearned revenues occur whenever you receive cash in advance for a service to be provided in the future. Once time has passed, we understand that this particular service has been provided, thus decreasing the initial liability, unearned revenue, of course, that had been recorded. So, a proper adjusted entry for unearned revenue would be to decrease the initial unearned revenue, which is a liability, while simultaneously increasing the revenue earned. So, we are going to debit the unearned revenue, and we are going to credit the service revenue. So we're halfway there, gang, but we have to come up with the proper amount. And how will we do that? By utilizing the information given in the problem. So it's a 10-month contract. It started from January and it's going to go all the way through October. But we are making this adjusted entry at January 31st. Remember, the initial entry took place on January 1st, which means that 1 month has passed. So we have to adjust that unearned revenue, that liability, by 1 month because we've provided a service within this month. Therefore, our proper calculation will be to take the initial amount, which is $3,200. We're going to multiply that times the time that has passed, which represents the revenue earned. That way, we are talking about 1 month. Then we're going to divide it by the total months in which the initial amount was collected for. Therefore, we take $3,200 times 1 divided by 10, and that should give us $320, gang. And our description would be to record service revenue that was collected in advance. We're going to check the answer. Well done, gang. Moving on. Next, it tells us that total salaries for all employees was $3,600 for the month. Employees are paid on the 1st and 15th of the month. Okay, so what's going on? Every month, the employers are going to pay the employees $3,600 per month. But the payments will occur on the 1st and the 15th. Today happens to be January 31st, which means that a part of that payment hasn't been made. However, the actual salaries has happened already. So what are we referring to here? Anytime that we have an expense that has happened, but it hasn't been paid, that gives us a quite particular example of an accrued expense. Therefore, we have to make the adjusted entry accordingly. Anytime you have an accrued expense, you will always debit the expense and credit a payable. Because by definition, an accrued expense is an expense that has happened that hasn't been paid. Therefore, we're going to debit salary expense and credit salaries payable. Now, we have to come up with the correct amount, gang. And what are we going to use to calculate the correct amount? The dates of payment. We know for this particular situation that the payments are made on the 1st and the 15th. Today happens to be the 31st, which means that the last time they were paid was on the 15th, which means that half of the total month hasn't been paid yet. It's going to be paid the following year on January 1st. So we have to account for half of the $3,600, gang. So if we simply divide that into 2, that will tell us how much it is, and we already know that's $1,800. And of course, this is to accrue salaries expense. Check the answer. Excellent job, gang. Moving on. Next it said it work performed but not yet billed to customers for the month of $1,600. So what are the key words? Work performed, not yet billed. So in this situation, we performed some work. We provided a service, but we haven't billed our customers yet. We know whenever we provide a service, revenue is earned. Therefore, this is an example of an accrued revenue. Why? Because by definition, accrued revenues are revenues that have been earned, but they haven't received the cash yet. Since they haven't received the cash, the proper adjusted entry would be to debit accounts receivable, increasing accounts receivable, while simultaneously crediting service revenue, increasing service revenue. So we're going to make that entry. We're going to debit accounts receivable and credit service revenue for the amount listed, the $1,600. Accrued revenues are easy, gang. You guys have been doing this from chapter 1. It's just now we put a name to the madness. And of course, this is to accrue for service revenue. Excellent job. And last but not least, the company pays interest on a $16,000 4% notes payable of $53 on the first day of this month, each month. So, what's going on with this? The company borrowed some money by receiving a note. Note meaning a long-term liability. Since it's a note payable, it will involve interest. Since the company is paying interest, interest paid to someone else is considered an expense to the company. Therefore, we have a situation here in which interest expense has happened, but the company hasn't paid it yet. Why? Because it pays it on the 1st of each month. And since today is January 31st, it actually has a month of interest expense that has happened, but will not get paid until February 1st. Therefore, we have to make the proper recording of an accrued expense. Accrued expenses are expenses that happen that hasn't been paid. And anytime you have an accrued expense, you debit the expense, credit the payable. So we're going to do that, gang. We're going to debit interest expense and credit interest payable for the amount that was given of $53. Then we're going to look for the explanation, and that's simply to accrue interest expense. We're going to check the answer. Bags all day. So there you have it, gang. A quick, easy illustration of how to properly record adjusted entries at the end of the period. Hopefully that light bulb was clicking, and if so, smash that like button. Call your friends and send them the channel so they can chase the bags with you as well. As always, I'm Dr. Who, and it's always my humble pleasure for you guys to spend your time with me. Really appreciate that, and I will see you soon. Bags!